in a market that's constantly changing, if you're not repositioning yourself at least once every 3 to 5 years these days, just given how fast, tech cycles are moving, I feel like you have to adapt and sometimes even risk, disrupting yourself.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to the Run the Numbers podcast. We got a legend of Wall Street here. Hamza Fodderwala, executive director at Morgan Stanley. This is the banker who's got the goods. We start with the basics. What's the real difference between the sell side and the buy side? And why does it matter if you're a CFO trying to shape your company's narrative? From there, we dive into the heart of the job, how financial storytelling, transparency, and strategic communication can move markets really just as much as the results. And Hamza has worked closely with countless CFOs and seen firsthand the difference between those who know how to engage with the street and those who, they don't catch the drift. So he'll break down what makes a financial story land with investors, how the best CFOs turned around narratives, not just numbers, and why consistency in messaging is more powerful than you might think. We also get to the delicate art of disclosure. This is one of my hobbies, one of my pastimes. If I'm sitting around a fire over the summer, I talk about metric disclosure. When is transparency a trust builder and when does it become noise? Can you ever pull back on metrics without spooking investors? And how do companies balance short-term pressure with long-term vision in a world obsessed with quarterly results? Like Vin Diesel said, you're living life a quarter mile or quarterly earnings call at a time. Plus, why stocks can tank even when companies beat expectations. That one has always messed with my brain. And what makes an earnings call truly exceptional? And the one phrase that he just wishes we could ban from investor communication forever. Pick your favorite buzzword. If you're a CFO, an operator, or just a market curious listener, this one is packed with insights. All this and much, much more after a short word from our sponsors. What does the future hold for business? Ask 9 experts and you'll get 10 answers. Bull market, bear market. Rates will rise, rates will fall. Can someone please just invent a crystal ball already? Until then, over 40,000 businesses have future-proofed their companies with NetSuite by Oracle, the #1 cloud ERP, bringing accounting, financial management, inventory, HR into one fluid platform. With one unified business management suite, there's one source of truth, giving you the visibility and control you need to make quick decisions. With real-time insights and forecasting, you're peering into the future with actionable data. Whether you're closing the books in days, not weeks, you're spending less time looking backwards and more time on what's next. If you listen to this podcast, you'll know I ask CFOs all the time to rep their tech stacks, and I would say almost every one of them use NetSuite. And that's what I would use too. Whether you're a company earning millions or even hundreds of millions, NetSuite helps you respond to immediate challenges and seize your biggest opportunities. Speaking of opportunity, download the CFO's Guide to AI and Machine Learning at netsuite.com/metrics. The guide is free to you. That is netsuite.com/metrics. Ooh, yeah, it's netsuite.com/metrics. Please, guys, I really need this. Ready to plan confidently, close faster, and report with accuracy? Here's what sets Planful apart. Imagine purpose-built solutions for every department, from FP&A to accounting, marketing to HR, all with built-in financial intelligence. It's easy to implement Planful in just weeks with minimal IT involvement, enabling seamless collaboration across your organization's key financial workflows. Best of all, Planful grows with you. Its unmatched scalability ensures that no matter how fast your business expands, Planful can keep up. See why over 1,500 customers worldwide choose Planful as their flexible, user-friendly, end-to-end financial performance management platform. Visit planful.com/metrics to see how you can elevate your team this year with Planful. They will hook you up. It is planful.com/metrics. Tell them your boy CJ sent you. Planful.com/metrics. I got a question for you. Is your billing system slowing you down? For most B2B SaaS companies, it's like a total mess. Manual invoices, revenue tracking workarounds, and endless spreadsheets that drain time and create errors. I've seen some ugly spreadsheets in my day. Your billing shouldn't feel like a never-ending math problem. That's where Subscript comes in, the modern billing and revenue recognition platform designed for SaaS finance teams that need both flexibility and accuracy. From automated invoicing and dunning to compliant, transparent revenue recognition and real-time analytics, Subscript eliminates manual work, reduces errors, and gives you a single source of truth for all your financial data. Finance teams using Subscript save over 20 hours a month. Wow. Closing the books faster and making smarter decisions with confidence. Don't let billing hold you back. Start scaling with ease. Learn more and book a free demo today at subscript.com. That's subscript.com. Tell me boy CJ sent you. They'll hook you up. Hamza, welcome to the podcast, my friend.
CJ, thank you for having me. Glad we were finally able to connect.
I have to point out the irony to everybody that arguably the top sell-side equity analyst for cybersecurity companies was blocked from the podcast due to a firewall issue.
That is ironic indeed. Perhaps I'm not as marketed, so we'll see.
No, you're the man with the goods here. I'm pumped to have you on the show. We had crossed paths a couple times in my past life when I was running investor relations and FP&A at a private cybersecurity company, Sneak. And I wanted to illuminate the audience on kind of what you do, what your day is comprised of, and how CFOs can better interact. So you ready to jump in?
Let's jump in.
I want to start simple here. So people hear sell side and buy side thrown around a ton. Can you just give the 1 minute explainer of what's the fundamental difference?
Yeah, I still have to explain to my wife at times what that is. But basically the sell side, largely, investment banks like, Morgan Stanley, Goldman, JP Morgan, et cetera, we're responsible for, facilitating transactions of securities, including stocks. So what that means in practical terms is obviously, the investment banking side, companies that want to go public, they want to raise capital, they come to us, and we sell those, issuances. And then once they do go public, right, the sell side, if you will, on the research side, covers those companies. They create the consensus forecast, they write on these companies, and ultimately that drives liquidity, that drives flow, that drives conversation. And that's, good in terms of, more efficient capital markets. And the buy side is basically, buying the stocks, right? They're buying, the CrowdStrikes or the Apples or what have you to generate a return for their investors and for their funds. And so sell side, again, facilitating the transaction, offering the coverage, helping to drive liquidity. And then the buy side ultimately, buys those stocks, buys those securities to generate return for their investors.
And we talk about revenue multiples all the time and how valuation can work. You're the one who's coming up with the next 12 months estimate, right?
Mm-hmm.
Yeah. So people, when you're looking at valuation multiples and we're talking about NTM revenue multiples, that's coming from people like Hamza over here. What are some of the companies you cover?
So I am an equity analyst. I cover software and cybersecurity. So companies like Palo Alto Networks, CrowdStrike, Cloudflare, Zscaler, and others. That's a sector under my coverage. And so I've been at Morgan Stanley for a little over 9 years. About 5 years ago, took over lead coverage of our cybersecurity space. And so I spend a lot of time again focused on the cybersecurity software market, and then I've done a lot of broader software as well. And so my job is just, day to day, we'll probably get into it, but just trying to analyze these companies and trying to figure out, who are going to ultimately be the share gainers and, or the share donors.
And we talk about storytelling all the time on the podcast, and you're kind of at this nexus of like you're helping to shape narratives around companies and stocks and giving your perspective, but you're also reading into the stories that CFOs are presenting to you and CEOs and saying like, do I believe this or not? Would you say that storytelling is like a large component of what you do day to day?
100%. So like the two things that are going to drive any stock, right, particularly in the short term, but the long term as well, are the numbers and the narrative, right? There are a lot of stocks that, might be putting up great numbers, right? But the story isn't as compelling, right? A lot of times investors, they want to invest behind big themes, right? AI is a predominant theme right now. So if you're aligned to that theme, you're going to see a lot more investor interest, a lot more flows. Cybersecurity has been a big theme, right? And so that's an area that investors want to invest behind as well. So I think thinking about storytelling, thinking about these big themes and aligning, your company to these themes to some extent is helpful. Or if it's a story that's, relatively new, right? Explaining why this is going to be a big opportunity that's going to generate meaningful return, not just for the next 12 to 18 months, but for the next 5 to 10 years. That's really how you get, the multiple, right? You get these high multiples, you get the multiple expansion. because that's largely what's driven the stock market, right, in the last few years, especially, CJ. So like, if you think about it, if we look at a company like Palo Alto Networks, for example, or CrowdStrike, right? CrowdStrike a couple of years ago, was considered a single product company. When they started to become more of a platform, right, we saw the multiple re-rate alongside that. So storytelling is very important.
It's really fascinating how you said, do you align your company to a theme? Because you can either align your company to a theme or you can try to create a category or a theme and educate people to it. We had spoken to Eliran Glazer, the CFO of Monday.com, not in the cyber realm at all, but still like a cool
Great
company to
by the
talk
way.
about in terms of their storytelling, owning the narrative. And it's kind of like you can be your authentic self and own the story, which can be risky. And you better have the numbers to back it. But if you do, that's like a match made in heaven. Or you can align to, like you said, like AI is really big right now. How do I ride that wave?
Exactly. I'd say, aligning yourself to a theme is easier than creating a new category. But the great thing about, if you make the investment in creating that category and you're able to convince investors, well, now you're the category leader, you're the category definer. And so, that does set you apart in a fairly unique way.
What makes a company's financial story compelling to the market? I realize that you kind of split it into two different parts there. It's like the narrative qualitatively, but then it's the numbers as well that have to play a role.
Yeah. So I think the way I would describe it is, you're trying to sell a vision to investors on why they should invest behind you for the next 10 years. And you're reporting every quarter, right? Maybe you're having an analyst day once a year or once every other year to give an update on the longer term view. I think whatever numbers you're giving, whatever KPIs you give, have to align with the broader vision, the broader story. So the way I would describe it is, you have a vision, let's say for the next 5 to 10 years, that you want investors to invest behind. And each quarter really is a chapter in that story, right? Each quarter is building to that ultimate outcome that you told investors you would achieve. And that's how I would think about, when you're thinking about disclosing metrics, when you're thinking about disclosing any KPIs, is, okay, is this a worthwhile KPI to convince the longer term investor that we're on track or ahead as it relates to our longer term vision and projections? And so, that's I think one thing to me that great companies do well versus the companies, who haven't really found that footing.
What's an example of a company that turned its investor narrative around through better storytelling? So not just better results.
Yeah, I mean, a great example of that in the last, 3 to 4 years in particular has been CrowdStrike, right? So CrowdStrike was a company that, a while back we were less constructive on. Obviously, we're more constructive these days, but that was a company that was in the cybersecurity space, did well initially as a public company. And then there was a real debate around, okay, this is a company that's grown well, but are they hitting a wall, right? How much of their revenue is coming from this one single product in endpoint detection and response, which is a big market, but now they've gotten to, considerable share, and you have competitors that are potentially driving down pricing. And so what a CrowdStrike was able to do was really transition into that broader platform story, right? They gave you metrics around, what percentage of the ARR was coming from what they called emerging products. And so every other quarter, they would give you that disclosure alongside other, KPIs like net retention. Obviously, ARR was a very important metric that investors tracked as well. And so, for them, it was, every quarter was obviously they wanted to deliver on the numbers, but they always tied it back to the broader vision, right? And so once investors started to be convinced of that platform story and the overall numbers, aligned with that, you didn't have to see a 10, 20%, revision on the, ARR free cash flow estimates to drive the multiple much higher, because investors believed in the durability of that growth longer term. And so the multiple drove a lot of the upside in the stock. I mean, I think it bottomed at, 120, 130 a couple of years ago. And now it's, back above all-time highs, despite what was a pretty significant event 6 months ago. I don't know if you heard.
Yeah, it made the news, I think. A company that I think has told a really good platform story with metrics is Datadog, because they talk about how many customers are on multiple products. So they always include that cool chart where it used to be like customers on 2 products, customers on 3 products. And eventually they had to like roll off some of the categories because you get to a saturation point. But I'm pretty sure the chart now shows like companies on 8 products. It's like, whoa.
Yeah, I mean, I don't cover Datadog specifically, but there are a lot of companies who do that. CrowdStrike does that as well, and I think that's a great metric to show. But I think eventually, what happens with companies, great companies, is that they do really well in the first act or even the second act, but then they don't really find that next act that's going to take their business from 1 billion to 5 billion in ARR or 5 billion to 10 billion in ARR, right? So finding those multiple acts is what separates, a very large company from a smaller one, right? So CrowdStrike would give that metric, and it was a great metric, that investors would follow. But once they started to show the emerging product metric, the difference there was, hey, these are entirely new categories that we're going into or evangelizing altogether, like markets like identity threat detection and response, for example, which became, $100 million ARR business. Today is over 300 million in ARR. And they were really able to show investors that, we found that next act or that third act that's going to, enable us to get to 10 billion in ARR over the next 5 years.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Hey, metrics fans, let me ask you something. Do you know what keeps CFOs and finance teams up at night? Well, it's not the complex analyses or forecasting models. It's the mind-numbing tasks of chasing receipts, reconciling expenses, and juggling 5 different systems just to track company spending. I was talking with a finance leader last week who calculated her team was spending an astonishing 20 hours weekly just on expense administration. That's nearly 1,000 hours annually on low-value tasks. That's why I'm excited to tell you about Rippling Spend. Rippling Spend is the only platform that automatically handles your entire company's spending in one unified system. What makes it different? It's built on Rippling's workforce platform. So when org changes happen, like someone getting promoted or changing departments, all approval workflows, access permissions, and policies update automatically. Picture this. When your marketing director goes on vacation, expense approvals don't sit in their inbox waiting for their return. Instead, they're automatically routed to the right backup approver. No manual delegation needed. Meanwhile, your finance team gets real-time visibility into all company spending with no more month-end surprises. As a Run the Numbers listener, you can get an exclusive demo showing exactly how much time your org would save. Just visit rippling.com/metrics to learn more. That's rippling.com/metrics. Do it, guys. Trust isn't earned, it's demanded. Whether you're a startup founder navigating your first audit or a seasoned security professional scaling your GRC program, proving your commitment to security has never been more critical or complex. That's where Vanta comes in. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks, like SOC 2 and ISO 27001. Centralized security workflows, complete questionnaires up to 5 times faster, and proactively manage vendor risk. Vanta not only saves you time, it can also save you money. A new IDC white paper found that Vanta customers achieve $535,000 per year in benefits, and the platform pays for itself in just 3 months. Join over 9,000 global companies like Atlassian, Cora, and Factory, who use Vanta to manage risk and improve security in real time. For a limited time, our audience gets $1,000 off Vanta at vanta.com/metrics. That's vanta.com/metrics for $1,000 off. Here's a question. When was the last time you really had time to focus on growth and not chasing contract renewals, tracking shadow IT spend, or explaining rising software costs to the board? Yikes. The truth is, traditional spend management is broken. If you're still piecing together data from 5 different systems just to figure out what you're actually spending, while vendors keep on pushing those auto renewals and price hikes, my friend, I got a solution for you. That's where Tropic comes in. Tropic is an intelligent spend management solution that consolidates your spend data and processes into one unified offering, enabling insights and decisive action. It doesn't just show you where the problems are, it helps you solve them. From spotting hidden optimization opportunities like duplicative spend, to automating those painful procurement workflows, to giving you the best market data that turns every vendor negotiation in your favor. Tropic combines smart insights with real human expertise to keep you ahead of the curve. And I can say firsthand because I've used them for over 2 years. Their SaaS platform helps me with price checks. It helps me keep my calendar organized of when renewals are coming up, and I can actually visualize it. And let me say, it saves me more than 10 hours a week on vendor management, and we've saved a ton on renewals. I'm walking into the boardroom with a lot more confidence. Isn't it time to turn your spend management into your competitive advantage? Visit tropicapp.io/mostlymetrics. That's tropicapp.io/mostlymetrics. Let's talk about the CFO's role in shaping the story. What's the difference between a CFO who really knows how to work with the street and one who struggles?
I think if you think about, the CFO role, it's not an easy job. I mean, I know a lot of investors like to give CFOs flack, but I mean, it's obviously you have to run the business as an operator, you have to know the numbers, and then you have to be able to tell the story. And so I think the CFOs that set themselves apart are not only good in sort of explaining the numbers, setting reasonable expectations, but are also, strategic thinkers, right? Again, they're able to tie back the numbers to the broader vision, the story that they're trying to tell. And so I think, as far as a good CFO is concerned, you have to be able to manage expectations, right? You always want to be setting guidance that you can, over deliver on, right? Rather than under delivering. You want to be able to put in some cushion for uncertainty. So you want to be aware of, the macro and the demand environment. So I think a lot of good CFOs will oftentimes, they'll talk to the sales team, right? They'll talk to the CRO or the go-to-market teams to get a sense of, what the demand picture is like and what the conditions are like out there. And that will inform the guidance. And then, they'll be able to sort of tie that back into what the longer term goal is, right? So every metric you're giving is aligned to that longer term growth algorithm. And I think that's where, the CFOs will oftentimes set themselves apart is, setting the expectations, right? But then tying that back to what the longer term goal is, which is, ultimately, like if you're CrowdStrike to be a $10 billion plus ARR company longer term, right? Not every story is linear, right away. You're going to have, maybe black swan events like, major outages that come in between that. But again, tying that back to, okay, you know what, this was a bit of a setback, but longer term, this is still where we're going to get to. And here's how.
If you're listening to an earnings call, you're getting ready to ask some follow-up questions and you're like, just the vibe is off here with the way the CFO is telling the story. What are some of the common mistakes?
Yeah, I think it becomes clear if somebody doesn't know how to answer the question, right? Because maybe it's a question that they're uncomfortable with, or they're uncomfortable giving a disclosure inadvertently that they don't want to give, right? Because then it's always a chess match between analysts and, management in terms of, we oftentimes investors want, more disclosure, right? But from a management perspective, if you give something out, people are going to expect it every quarter. And so I think the mistake often is, if you're answering a question and you don't know how to answer it, or if it's a follow-up question and it's something that maybe you don't feel like disclosing or something you want to hide, which becomes, clear, I think it's just around, finding a way to talk around it. Obviously, maybe like I'm trying to talk around this question to some extent, giving a metric that is adjacent to that, question, but, doesn't directly answer it. So for example, we have a company, that's going through a SaaS transition right now, right? And that company has been asked for a few times, to disclose their net retention rate. But instead of giving a net retention rate, they give, hey, here's a percentage of our ARR that's coming from existing customers versus net new, right? Then investors can maybe back into what that NRR might be until the company has a large enough renewal base to disclose that metric, right? And so, giving ancillary metrics that might be related to the question, as opposed to, getting uncomfortable and kind of trying to dodge things, you never want to be in a situation like that. So having something in your back pocket, anticipating what those questions might be, so you're prepared for that answer, I think is ultimately where you want to be.
Is there one metric out there that you're always like, I wish they would just give me the damn metric? Is there one that they don't want to give you that would make your life easier?
I mean, every company's different, but I do like ARR. I think ARR is a very clean number for the most part. And I think every software investor analyst is ultimately trying to determine what the software company's bookings were that given quarter or that given year, right? And in the past, the best proxy for bookings was billings, and then billings sort of started to become a tougher metric to follow for various reasons. And then it became, CRPO, but then there's, nuances when it comes to CRPO versus RPO. And then ultimately ARR, I think is a great metric. Obviously, it's one that, companies have some discretion in terms of defining, but as long as it aligns with, the standard definitions, I think it's a good metric to look at in order to look at the underlying bookings for a company.
We spoke with Bill Kofed, the CFO of OneStream, and he was joking that sell-side analysts always want to try to walk you into giving the bookings number.
That's always what we're trying to figure out, what is the leading indicator, and that's ultimately bookings.
Totally. This may be a completely stupid question. I asked you, like, when a CFO may get tripped up or you may be like, something's not right here. Can you tell if a CFO doesn't truly understand the underlying technology?
Yes. Look, CFOs don't have to be technologists. I think if you get a question that is beyond your depth, that's not your job, right? So you can say, hey, I'm not sure, I'll follow up and I can connect you with our product folks, right? So I wouldn't judge a CFO or someone in the finance organization who's like, what, I'm not actually sure how that technology really works. If you want to know more, I'm happy to connect you with the product team. Like, I don't think that's your job, right? And so
I think a lot of people are relieved hearing that. And I asked out of a place of vulnerability where I've dealt with backup and recovery products and cybersecurity products. Where, like, I can tell the story, but if you asked me, like, where in the CI/CD is this, or whatever you want to call it, like, I'd be like, should I try to take the bait on this one, or should I just defer?
Yeah, when in doubt, defer.
Okay. I want to talk about consistency in messaging. We talked about consistency in metrics, which we may touch on again later. But, like, how often can a company afford to shift its narrative and try to reposition itself? Is it risky if you're trying to move things around to sound better?
I think in a market that's constantly changing, if you're not repositioning yourself at least once every, 5 years or even 3 to 5 years these days, just given how fast, tech cycles are moving, I feel like you have to adapt and sometimes even risk, disrupting yourself. And so, I think I would say 5 years, right? Like, hey, we're in the last 5 to 10 years, the big shift was on-prem to cloud, and now it's cloud to AI, right? So you're seeing a lot of companies realign their pricing models or their business strategy. Align with that, you're seeing companies move from seat-based pricing to maybe outcome-based pricing or consumption-based pricing. We saw that recently with ServiceNow. We're seeing that to an extent with companies like Salesforce. And so it really depends on, the tech cycle, if you will, right? If we're seeing major shifts in technology platforms, I think outside of that, every 5 years, and then, if you're having a 5-year type transition or you're changing the business, making sure you have consistent metrics that can measure the progress around that transition. So ultimately, investors can have visibility on at the light at the end of the tunnel.
Mark Benioff of Salesforce has got to be the best at being able to get these meaty chunks of 4 to 5 year thematic epochs that they're going after and telling the story.
With Agent Force, that's been a big theme. AI agents, they were early on that trend and that narrative, and so the question now is if they can execute. But certainly after that Dreamforce conference in September, you did see a lot more investor interest.
I want to hit on transparency and disclosure here because not every metric makes it to the light of day. Do any examples come to mind of retiring a metric gracefully, if you will?
Yeah, look, you want to let investors know, a quarter or two in advance, but like I would say, going back to CrowdStrike, they used to give a customer count every quarter, right? And the problem is, like, now you're going after larger customers, or you might have, MSSPs, managed security service providers, that count as one customer, but target, hundreds of customers, because they're a partner. The customer count metric no longer becomes relevant. And, as you become a bigger company, right, the customer count isn't going to grow as much. Salesforce is the same thing many years ago. Adobe used to give a a subscriber number and they stop giving that. And I think just, being transparent about it, letting investors know in advance, hey, we're no longer going to get this metric because we feel like we've reached a certain milestone or scale in our business that this is no longer as relevant, right? So just look at the total ARR of the business because we've got other growth levers than just new logos or what have you.
I found that such a fascinating transition that many companies have made, where you used to be able to pick out the exact number of customers they closed the quarter with. But after a certain scale, they're like, no. This is the number of customers over $1 million, number of customers over $100,000. And it's like, oh, that's because you're trying to tell a story about moving into the enterprise. But what you're also kind of implying, if you think about it, is these smaller companies that are customers, they matter, but they don't really matter to the narrative that I'm telling.
Yeah. I mean, depending on the company, 70, 80% of your opportunity is going to come from that large customer cohort, right? And so I think, that's the story you're ultimately trying to tell.
Another metric that I think has had a fascinating run over probably the last 4 years is net dollar retention. Like, I remember Snowflake used to give you the exact number. I don't believe they do anymore. But you could be like, oh, they were at like 211% this quarter. But now most companies just give like a threshold, right? They say like we were above or below our threshold, which is usually like a 120% number.
Yeah, that's qualitatively something you can do. I think, you can do that on a quarterly basis to give investors some context, right? Going back to the question around, hey, what if you get a question from an investor or follow up that you're kind of tripped up on?
Oh.
Giving some sort of guardrails around, this is the threshold, or this is what we consider best in class, and we were, in line with that threshold, or we were slightly below the threshold or slightly above. So investors can kind of make their own estimates and the analysts can make their own estimates. But I think if you're going to speak to a threshold, I do think it's important to think about disclosing that actual number, at least on an intermittent basis. So maybe once a year. So CrowdStrike, for example, again, going back to them, they will disclose their net retention, once a year. They'll give you like a 4-quarter view on it. Varonis is another company that gives you a net retention, once a year. And then you can kind of speak to it every quarter, right? Around where you were relative to where you ended at in the year prior.
We spoke to Guy Melamed, CFO of Varonis, on the podcast. He was an awesome guest, fellow BC Eagle. And he was describing to us how they had to undergo a transition in the public light. I think at one point, and maybe they were private at the time, but they went from perpetual to SaaS, and then they had to go from SaaS to cloud. Like, you got your job cut out for you when you have to tell the narrative there, and you also have a changing cast of metrics.
Yeah, definitely. And, they've gone through multiple transitions and have been, had a lot of success in those transitions. So, they went from on-prem to subscription, so term license, during ASC 606 too, which, complicated things further. And then now they're going from on-prem subscription to SaaS, and, they're ahead of their SaaS transition. But I think the debate really is, once they do convert their customers to SaaS, what is the growth rate going to look like, once you're no longer converting these customers at a 20, 30% ASP uplift? And so going back to, the question around disclosures, right? And trying to find creative ways to tell investors, a story of what your long-term growth will look like. That's a company where I think a lot of investors are going to want to know what the net retention was every quarter, or they're going to want to know what the net retention was for the SaaS business versus the on-prem term license business. And so I think, on their end, while they've been executing very well in the transition, I think that some thought has to go around, okay, can we think about giving a net retention rate for the SaaS business versus the overall cohort? So investors can see actually, when we do move these customers to SaaS, that they tend to upsell at a much higher rate.
That's so fascinating. I never even realized that when you move a customer to SaaS, it gives you, I don't know, would you call that a one-time bump? I guess it's a recurring bump if it's turning them into ARR.
Well, yeah, if you think about it, I mean, if you're moving from on-prem to SaaS, right, you're basically taking the cost of running that software away from the customer, because now it's delivered, vis-a-vis, cloud. So I think, you do tend to see, pretty good uplifts as you make that transition, sometimes even more than 20, 30%, depending on, the profile of the customers.
I want to touch on guidance and the art and science behind giving good guidance. How much of that is already kind of baked from a perspective standpoint in your model, and how, like at the beginning of the year, and how much of it is kind of coming to light quarter to quarter?
So every company tries to beat, right? Every company is going to give you a guidance that they want to beat. I mean, there's obviously notable exceptions, which I'm not going to get into, but I think which companies are going to beat by a higher or lower magnitude based on your experience with the management team. So if the management team, it's a company that every year will miss their guidance and miss their forecast, that, okay, I'm going to bake in, more conservatism in my numbers. So, the CFO guides to some range, right? And I know my experience with them has not been particularly great. I'm going to model to the lower end of that range, right? If the CFO or the company tends to beat, by a high magnitude every quarter, I'm going to model to the high end of that range. And so generally speaking, you'll find, every company beats, right, their numbers, right? I'm sure you'll see a lot of folks who maybe are not in this day to day, and they'll see like, hey, this company beat EPS, but they beat revenue. Why is the stock down? Because, investors were already pricing in that beat. It just that the beat wasn't high enough to give investors confidence in the durability of that growth, let's say, 1-2 years out. And so as it relates to, how you go about doing that, it's a much longer conversation, but ultimately I think you want to lean on being more conservative than not. I think some companies might say, well, we don't want to show our lower growth rates to the street to make people think that we're slowing down, especially if our competitors maybe are growing much faster. But I would say, at a minimum, you kind of want to guide within, no less than 3 to 5% within plan. So like if you think you're going to grow, I don't know, 18% or 18% this year, right? In terms of your plan, you probably want to guide closer to 13, 15% and give yourself that cushion in case things get worse.
What's so fascinating is that there's a personal credibility aspect to this, right? It's like you have the business and the size of the engine of what it can reliably produce, but then it's also the umpire who's the CFO telling you like ball or strike, like how fast is this thing going to go?
Exactly. And the thing is, credibility premiums built over time, right? Another great example of that, a company, from your hometown in Boston is CyberArk, right? And CyberArk went through is still going through a transition to SaaS, and they've been doing quite well. And despite what's been pretty down macro in the last 2 to 3 years, they've consistently beat and raise on the ARR metric, right, which is the metric people look at to measure these transitions. And they built a credibility premium over time, and you've seen the multiple expansion drive a lot of the share price performance in addition to the numbers.
Is there an amount to beat by that's actually like, oh, you don't have control on this business? Like if you blow it out by 8%, are you like, that's also a bad sign?
I think ultimately you just want to look at consistency of beats. I'd much rather, have a company beat by, 2 to 3% every quarter. Obviously, as you scale, the magnitude of those beats come down, right? And so that's also important to message to investors like, hey, we're not a $500 million ARR company anymore. We're a $2 billion ARR company, and the beats are not going to be as big. But I think consistency of beats is important versus, a company beating by 8% one quarter because they happen to close a large deal, and the next quarter, they miss by 1% or, barely come in line.
It just feels like a not too hot, not too cold kind of game.
Goldilocks, exactly. Yeah.
I like how you called out the math, which should have been more obvious to me, that like as you get bigger, the size of the beat is smaller. Because like if you're a $3 billion revenue business, beating by 1% is actually a ton of money relative to other companies.
Definitely. Yeah.
If a CFO asked you, Hamza, I'm giving a ton of metrics here. Is there one I should just stop giving because you don't find any value in it? What would your response be?
Yeah. I mean, I think, again, like going back to retiring metrics. So if a CFO is like, look, we used to give a metric, let's say customer count, right? But now we're a much bigger business and we're going after larger customers. Is this a metric is still a metric worth giving? And I would say no. You don't want to flood people with a lot of metrics because then they don't know what to focus on. They're just like, okay, hold on. Like, what are you actually doing? Like what is actually driving your growth? What is the KPI I should look at? And I really feel like every company, regardless of size, should have maybe 3 KPIs that matter every quarter. And then if there's ancillary metrics you want to give, like once every 6 months or once every year, that's fine. But like trying to flood people with metrics, because then it's like, then you can kind of pick and choose like which one to look at. But 3 metrics, right? Like real KPIs that are not reported P&L items, I think are important. So like, if you're a SaaS company like CrowdStrike, then like ARR, net retention rate, are obviously going to be very important. If you want to give percent of ARR on, emerging products, right? Or, 100K plus customers to show how you're, moving to large markets, or $1 million plus customers. I think that's important. But, just be consistent on those 3 KPIs. And, as you scale, right? Again, like it makes sense to retire certain metrics. If you're no longer going through a SaaS transition, right, then you don't really have to disclose what percentage of your new bookings were on subscription, because, once you get to 90% of new bookings on subscription, then you're done, right? And so I think there's things you can retire. Just be transparent and, forthcoming about it early.
That makes a lot of sense. So you can roll off metrics if you do it the right way. It's a risky game to play. You cover companies like Fortinet, SentinelOne, Okta, Zscaler, Cloudflare, Checkpoint, Qualys, Tenable. When you look at those companies and the different macro fluctuations that they've gone through, how are you able to separate like the business itself versus like what's going on in the broader economy? Like, and I guess it's kind of a philosophical question, but like, are you looking at like a buy sell rating based on the macro and the company, or is it more just like the company itself, neutral of any macro environment?
I mean, you're always trying to look for idiosyncratic stories that are going to return, different levels of upside, right, or downside, what have you. And so I think in this environment where there's still a lot of uncertainty and we're seeing rolling recessions in various parts of the economy, right? So like last 2 years, we saw a recession in tech after what was a COVID boom. Maybe now we're seeing the recession in the federal government, given what's going on with Doge. And so I think in an uncertain environment, you're looking for companies that can deliver idiosyncratic upside. And so, we tend to have a macro view, right? And that macro view might, determine if we're just bullish on the sector in general, right? And then, but even if the sector, let's say, is going through a downturn like it did in 22, there's going to be, companies that are going to return idiosyncratic level of upside. And so, we tend to have a view of what the space is growing at. We track, bookings metrics or a best estimate of bookings metrics for each company every quarter. We try to develop a mosaic of what the industry is growing at. Not everyone slows or accelerates at the same pace, right? So our job really, honestly, a lot of investing these days, particularly in the short term, is just spotting, trough rate of change versus peak rate of change. So an example of that last year is Fortinet, for example. Fortinet, had a big boom in their firewall business coming out of the pandemic, and supply chain constraints that drove their pricing much higher. So their revenue growth was growing north of 30%. But once you got out of that cycle, right, and a lot of their business is driven by hardware sales, their growth rate decelerated a lot too. But we were able to identify what the trough rate of change was, and we saw growth rate inflect in the last couple of quarters. And so I think it's just spotting, okay, what is the industry growing at, right? We know longer term what these industries will grow at, but that doesn't mean every year they're going to grow 15, 20%. Right now, I'd say you're hard pressed to find, really any company that's growing 30% plus this year besides maybe Palantir. And there's fewer and fewer companies that are growing north of 20. And so I think, in a world where growth is slowing and we don't know what the bottom is yet, if you've got companies accelerating because of a particular product cycle or they're gaining share, those are the companies you want to be, outperform rated on.
Your answer was way more eloquent than my question. I have to applaud you on that. The way that you described trough versus peak makes a lot of sense, because what I was envisioning is you could have a company that's growing 30%, but everyone else is growing at least 10% just because of the tailwind behind the market. So it's like, okay, maybe 20% is from your execution. And then it can go the other direction too. Maybe you're growing 20%, but everybody is moving backwards by 10%. So you're actually doing a really kick-ass job above and beyond what the market itself is able to produce.
It's all relative. Yeah. At the end of the day.
I want to talk about long-term thinking versus market pressures. I think it's a nice segue. And you've spoken about winning the war, not the battle. Can you unpack that quote for me?
Yeah, look, I think businesses aren't linear, right? I mean, Microsoft had a period of underperformance where there wasn't a lot of growth until things took off. Oracle, we're seeing now, accelerate after many years where they were going through a cloud transition, and now they're coming out the other side. And so, I think in terms of winning the battle is, or winning the war over the battle rather. Every quarter you're gonna report. Maybe the quarter is not great, right? Or maybe it's a fine quarter, straight down the middle, but you're not really advancing the ball. Investors are gonna want metrics to gauge the underlying health of the business that isn't being expressed by the reported P&L items, right? And you can give those metrics, right, and try to be consistent on those metrics, but they're always going to want more if the overall business is not inflecting, right? At the end of the day, you can give as many metrics as you want, net retention rate, customers on multiple products, et cetera. But if the overall top line and earnings are not inflecting positively, then people are going to question those metrics. And so I think as you get through 1 or 2 quarters or 3 quarters, right, investors are impatient and they're going to say, well, look, I'm not seeing the inflection in the overall business. Is there something else, some other metric you can give me that I can look at to gain more confidence in this ultimate inflection that you're talking me to? And I think trying to be patient and just saying, you know what, like we're consistent on these metrics, right? We think these KPIs are ultimately what they'll tell the story, and we think the overall business will align to these KPIs. That's called discipline, right? And like I think a big part of an IR job or a CFO's job is having the discipline to be consistent on the metrics, be consistent on the story when the overall business is inflecting and investors just want you to give more and more and more. And then eventually, once those metrics do align with the overall business, that's when you see the goodness. That's when you see the revisions, and that's when you see the multiple really expand. And that's when you win the war, right? And whereas if you try to fight every battle and you give different metrics every quarter, then all of a sudden, let's say one metric comes down, even though the metric that you were giving all along suddenly inflected, and then investors have another thing to pick at, right? So it's a catch-22. You give something, right, because it looks good, but then in 2 quarters, maybe you got to pull it, or it doesn't look as good, and you got to talk around it. And so just trying to be consistent and focus on the war over quarterly battles, I think, is really important.
And it does feel like a lot of revenue cures a lot of sins.
Sales cures all, ultimately. That's exactly right.
It's a difficult job, though, if you're a CFO or an IR person, because you're trying to build this and maintain this long-term strategy, but then you also have people coming in and out of your stock and people with different expectations quarter to quarter. So it's like you're trying to do something long-term, but you get measured for it every 90 days.
Exactly. And so you really want to focus on telling the story to the longer term investors, the long onlys, if you will. I mean, there's certainly a lot of folks who might have, a shorter duration, right? That maybe isn't every quarter, but maybe it's a 12 to 18 month duration who you can, take advice from as well. But I think you really want to focus on, okay, who is investing in my company over the next 5 years? And what do I need to tell them to give them confidence on the durability of this growth?
There's this idea that a stock price isn't just about the fundamentals as we hit on, but also expectations. Do you think companies should focus more on managing expectations than managing the results?
Look, in the short term, it's always an expectations game. In the long term, things tend to, equalize. So, it's the famous quote by Buffett, in the short term, the market's a voting machine. The long term, it's a weighing machine. I'd say the same thing about the expectations game. So I think you want to manage expectations, right? So like your stock might run up these days 50 to 100% intra-quarter because maybe, like the street did some channel checks and, things sound good, or, there's some data points that are inflecting for a company. So I think you just want to look at the stock and the business separately, right? And then be like, okay, the stock has gone ahead of itself, right, relative to where the business is today. So that's where you want to manage expectations, and you want to tell folks, look, like, we feel confident on the trajectory of the business mid to long term. Near term, like nothing is changing in terms of, the revisions trajectory of the business, the growth trajectory of the business. We're executing well. and it's, we're hitting or exceeding our numbers. And so that might mean your stock is down in the short term, but in the longer run, it's still directionally moving higher.
Can you think of an example when the market just like completely whiffed on a company's results and reading what it really meant and the stock price didn't really reflect reality?
There's probably multiple examples of, complete whiff is hard. I would say.
All right, foul ball.
Yeah, foul ball. Let's say that. There's been companies where they'll miss on a metric, let's say, and you're like, wow, the stock's going to be down 10% tomorrow. And maybe in the aftermarket, that's what it's indicating. And then ultimately, you see things recover. And I think, going back to CrowdStrike, right? CrowdStrike they reported their fiscal Q3 back in November, and they put up a ARR beat that was slightly above where the consensus was modeling, and then they took the Q4 ARR down. And initially, the stock was down on that, right? They had just come out of an outage, but then you saw things recover pretty quickly, right? Because ultimately, the company, the management team, had the foresight to be proactive and say, look, like, yes, we appreciate that, sell side cut their numbers after this worldwide outage, but they didn't cut it enough. And so we're going to use our Q3 earnings to proactively bring down the Q4 guide so that we can set up for beat and raise success, right? Which might be the case now. And so ultimately, the stock was still rewarded and got up to all-time highs, even though they might have lower their guidance for the forward quarter.
Hamza, if a company beats, let's say in Q3, and then takes down their Q4 guidance because they say they pulled forward big deals into the current period, do you buy that?
Yeah, depending on the company, I think certainly if you're doing that, if you're beating Q3 by a lot and then you're lowering your Q4 guide and you're talking to pull forward, then most likely that was the case. So I think being forthcoming and transparent about that, while you might get hit in the short term, in the long term, that will benefit you if people believe in your long-term story, because, if things do start to inflect, now all of a sudden you de-risk things way more, right? And so usually stocks will get rewarded if they're proactive about, managing expectations 1 or 2 quarters out.
Maybe gearing towards a close here, I just want to hit on a couple fast questions around earnings calls and investor communications. What's the best earnings call or most memorable earnings call you've ever listened to or been a part of?
Man, there's so many. I'm just trying to think of recent memory. Obviously, CrowdStrike post the outage. I keep using them as an example. Maybe I'll think of a different one. Cloudflare's most recent earnings call was, I think, one that's, sticking in my memory, at least these days. What they did was talk about a company that is able to align, numbers and narrative, right? So they come out in the quarter, they put up a good Q4. They guide the forward year ahead of the street. Q1 revenue actually ends up being a bit light because they're going through a transition in their contract structure.
Usually, if you're light on Q1, like, you're screwed for the rest of the year. That's not the quarter you want to miss.
Exactly, but they had explained it early on that they're moving more to usage-based revenue, so their revenue is more back-end loaded effectively. So the numbers were fine, right? But really, they came on. They sounded really positive on, their sales productivity inflecting. They had hired some new go-to-market leaders in the prior year, and they're starting to see the fruits of that labor in their bookings metrics. And then they talked about, their new product cycles as it relates to their edge AI opportunity. And so, I would encourage CEOs, CFOs to listen to that call. They came out guns blazing, good quarter, right? Not a blowout by any means, but really it was the messaging behind that and explaining why things were going to inflect further that really drove that stock up, 20, 30% post the print. And so, that's a quarter I would say sticks in my memory, and I think is a good way to think about, hey, maybe the numbers aren't showing it, but we feel confident about the business, and we really want to highlight that in terms of our qualitative commentary.
Investor days. A lot of people out there wondering if they should do an investor day. Hundreds of thousands of hours are probably put into them. Are they net positive or neutral? Do they move the needle?
I think net positive. I think investor days are great if your business is going through a transition, if you don't believe the revisions are going to be meaningful on whatever metric people follow, revenue, free cash flow, EPS, over the next 12 to 18 months, but you truly believe, 18 to 24 months out, 2 to 3 years out, once you come out of this transition, that the numbers are going to be way higher than what the street is thinking long term, right? Again, it's about the longer term trajectory. And so if you're like, look, my business is not going to be amazing for the next 12 months, but I really do think in 26, 27, things are really going to start to inflect. That's when you have an investor day where you give a long-term target or you give some sort of long-term picture that gets people excited, and the multiple will expand ahead of that. Remember, right? Like the market will generally discount 12 months in advance. So if there's no inflection in your business this year, that's not necessarily the end of the world, right? Because the market's going to look at 26, 27 as you get through the calendar year. And so that's where investor days are really helpful. And then also, if there's a shift in strategy, or some new product cycles that you're investing behind, that's important. So I say shift in strategy or a transition or some sort of, investment cycle that you're going through that you want to communicate, where on the other side of that, things are really going to start to inflect.
Hey, you mentioned giving a number for the long term. How many years out is too far out?
I'd say after 5 to 7,
Yeah.
that's a little too far. Like 10-year targets, I think are not.
I think Snowflake gave a 10-year target. It was like, oh, that's cool, I guess. I don't really know what to do with that.
You want to align it to like a business cycle, right? I mean, what's the length of a business cycle these days? Like 5-7 years or whatever, right? So, I've seen some folks do the midterm target in addition to a long-term target, right? But I'd say after 5 to 7 years, that's when, things get a little murky.
Yeah. All right. Last one I got for you. More of a spicy one. If you could ban one buzzword from earnings calls forever, what would it be?
Record quarter. By definition, if you're growing even 1%, that means that quarter was a record. And so I see a lot of companies say, XYZ company announces record quarter, right? At least in software land, right? If you're not growing, then there's
record ARR pisses me off the most, because like by definition, like if total ARR goes down, that's not good.
That's not good, exactly. And so I would encourage companies to move away from that. If you're putting that out there, let's say that's your headline, then I know that quarter was bad. So I would avoid doing that. That's
the inside baseball, man. Hamza, this has been a blast. I learned a ton. You made me smarter. I appreciate you carving out time for us.
Thank you, CJ. Appreciate the time and great podcast. I'm an avid listener and looking forward to seeing more episodes.
There we go. The bigwigs at Morgan Stanley tuning into the little guy and Run the Numbers. Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, LOL. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.